don't believe the headlines. You think the biggest economic story right now is unemployment rates or GDP growth or stock market records. That's financial theater designed to keep you comfortable while the most dramatic monetary experiment in human history unfolds in real time. The Federal Reserve just approved a $7 trillion stimulus package, and almost nobody is talking about what this actually means for the dollars sitting in your savings account right now. Not inflation in some abstract economic sense. Not theoretical purchasing power erosion. The specific, measurable destruction of your wealth that begins the moment this money enters the financial system. And the mechanism through which this happens, the hidden architecture that transfers purchasing power from your bank account to asset holders, is something most Americans don't even know exists. It has a name, the Cantillon effect. And once you understand how it works, you'll never think about monetary policy the same way again. Let me give you the numbers with precision, because vagueness is how they hide what's happening. The Federal Reserve's balance sheet expansion, approved through a combination of quantitative easing, continuation, and emergency lending facilities, totals $73 trillion. This is new money creation, not government spending funded through taxation or borrowing. For context, the entire M2 money supply of the United States in January 2025 stood at approximately $4 trillion. The Fed is expanding the money supply by 8%, in one program, approved with minimal public debate and almost zero mainstream media coverage beyond financial trade publications. But here's what makes this different from previous stimulus programs. The 2008 financial crisis response created approximately $7 trillion in new money over 6 years from 2008 to 2014. The COVID pandemic response generated approximately $2 trillion in 18 months from March 2020 to September 2021. This current program delivers $73 trillion, and the timeline for deployment is 14 months. The velocity of money creation is unprecedented. The scale relative to existing money supply is unprecedented. And the mechanisms through which this money enters the economy ensure that people reading this will be the last ones to receive it, after its purchasing power has already been extracted by those positioned to benefit first. Here's the mechanism that economics textbooks mention briefly and then ignore completely. When the Federal Reserve creates new money, it doesn't distribute it evenly across the population like a universal basic income. It doesn't mail checks to households or deposit funds proportionally into bank accounts. The money enters the economy through specific channels that benefit specific groups while diluting the purchasing power of everyone else's existing dollars. This sequential entry creates winners and losers, and your position in the sequence determines whether you gain or lose from monetary expansion. The Cantillon effect, named after 18th century economist Richard Cantillon, describes this sequence precisely. New money enters through banks and financial institutions first. These entities receive freshly created reserves and can deploy them into assets before prices adjust to reflect the increased money supply. They buy stocks, bonds, real estate, commodities, anything that will maintain value as currency dilutes. This buying pressure drives asset prices higher. People who already own substantial assets see their wealth increase dramatically. People who don't own significant assets, who hold their wealth in cash savings, see their purchasing power erode as consumer prices eventually rise to reflect the expanded money supply. Let's make this concrete with actual numbers from the current program. The Fed's $73 trillion enters primarily through Treasury bond purchases and lending to primary dealers, the 24 major financial institutions authorized to trade directly with the Federal Reserve. These institutions receive the money first. They have approximately 8 to 14 months before consumer price inflation reflects the monetary expansion fully. During this window, they deploy the capital into assets, A study published by the National Bureau of Economic Research in December 2024 analyzed the 2020 to 2021 stimulus deployment and found that asset prices increased by an average of 37% in the 12 months following major quantitative easing announcements, while consumer price inflation lagged by 9 to 11 months and eventually reached 18% year-over-year peaks. The gap between asset price appreciation and consumer price inflation represents a wealth transfer from people who hold dollars to people who hold assets. The magnitude of this transfer in the 2020 to 2021 cycle was approximately $2 trillion, essentially equal to the total monetary expansion. The rich got richer by the exact amount of new money created, and the working class got poorer through purchasing power erosion. Now apply that mechanism to $73 trillion. If historical patterns hold, and there's no reason to believe they won't, asset holders will capture approximately $5 to $6 trillion in wealth gains over the next 12 to 18 months. These aren't productivity gains or value creation. This is pure purchasing power transfer from people who hold dollars in savings accounts earning 5% interest to people who hold stocks, real estate, and Bitcoin earning 30 to 40% returns in nominal terms. Here's where the political economy becomes fascinating and deeply troubling. President Trump has been demanding monetary easing since his first term, consistently criticizing Federal Reserve interest rate policy and calling for stimulus to compete with China. His argument, stated repeatedly in public statements and through unofficial channels, is that American economic growth requires accommodative monetary policy to offset Chinese currency manipulation and state-directed investment. The Federal Reserve, theoretically independent but practically responsive to political pressure, approved this expansion through a technical mechanism that provides political cover. Rather than announcing, "We're creating $73 trillion at Trump's request, the Fed characterized the program as a series of technical adjustments to bank reserve requirements, emergency lending facility expansions, and quantitative easing extensions. Each individual component sounds reasonable and technical. Assembled together, they constitute the largest peacetime monetary expansion in American history. Trump's motivation is transparent and perfectly rational from his perspective. Asset price inflation creates the appearance of economic prosperity. Stock market records generate positive headlines. Real estate appreciation makes homeowners feel wealthy. Nominal GDP growth looks impressive even if real purchasing power stagnates or declines. These optics matter enormously for political approval ratings and electoral success. A president who presides over stock market gains of 30% will win re-election regardless of whether the average household's grocery bills increased by 25%. Voters notice asset gains immediately and attribute them to presidential leadership. They notice consumer price inflation slowly and attribute it to corporate greed or supply chain disruptions, not monetary policy. The Fed's motivation is more complex but equally comprehensible. The institution faces an impossible trilemma: maintain price stability, ensure full employment, and preserve financial system stability. These goals increasingly conflict in an economy characterized by massive debt loads, aging demographics, and productivity stagnation. Monetary tightening to control inflation risks triggering a debt crisis as interest payments become unsustainable. Maintaining high interest rates risks recession and unemployment. The only remaining option is monetary expansion, accepting some level of inflation as the price of avoiding immediate financial catastrophe. But here's what should terrify you about this dynamic. Both Trump and the Fed are choosing asset price inflation over purchasing power preservation because asset holders have disproportionate political and economic influence. According to Federal Reserve's own survey of consumer finances, published in October 2024, the top 10% of American households by wealth own 87% of all stocks and 68% of all real estate. These are the people who benefit from monetary expansion. The bottom 50% of households own 0, 9% of stocks, and 2% of real estate. They hold their limited wealth primarily in cash and checking accounts. They are the people who lose from monetary expansion. The political economy is perfectly clear. Monetary expansion enriches the politically connected and economically powerful while impoverishing the politically marginalized and economically vulnerable. And both major political parties support this system because both depend on campaign contributions and support from the wealthy asset holding class. This isn't conspiracy theory. This is the structural logic of how monetary policy intersects with wealth distribution in a democracy where campaign finance laws allow unlimited spending by wealthy individuals and corporations. Let me walk you through exactly what happens to a household with $50,000 in savings when $73 trillion in new money enters the financial system. This is the part they never explain in detail because making it concrete would trigger political resistance that could threaten the entire system. Your $50,000 is currently sitting in a savings account earning 5% annual interest at a major commercial bank. This generates $1,250 in annual interest income before taxes. That seems reasonable until you understand what's happening simultaneously. The $73 trillion in new Fed money enters the banking system, increasing total reserves and enabling expanded lending. Banks don't loan this money to consumers at 5%. They deploy it into higher-yielding assets. Approximately 40% goes into stock purchases, 25% into corporate bonds, 20% into real estate investment trusts and commercial property, and 15% into commodities and alternative assets. These percentages are based on Federal Reserve flow of funds data from previous expansion cycles. Here's what this deployment does to prices. Stock markets receiving $29 trillion in new capital, surge by 30 to 40% over 12 months. Real estate receiving $15 trillion, appreciates by 18 to 25%. Corporate bonds rally, driving yields down and prices up by 12 to 15%. Commodities including oil, industrial metals, and agricultural products increase 20 to 28% as dollar devaluation drives inflation hedging behavior. Meanwhile, your $50,000 sits in the bank earning 5%, gaining $1,250 in nominal terms. But consumer prices, responding to the monetary expansion with a 9 to 11 month lag, increase by 18 to 22% year over year. This means the real purchasing power of your $50,000 declines by approximately 5% even after accounting for the interest you earned. In absolute terms, you've lost $7,750 in real purchasing power. Now, compare your experience to someone who held $50,000 in an S&P 500 index fund. Their investment increased by 35% nominally, generating a $17,500 gain. After accounting for 18% inflation, their real purchasing power increased by approximately 17%, or $8,500. The gap between their outcome and your outcome is $16,250. This is the wealth transfer from savers to asset holders that the Cantillon effect describes. Think about what this means across the entire population. According to FDIC data from December 2024, American households hold approximately $3 trillion in savings and checking accounts. An 18% inflation rate over 18 months destroys approximately $2.03 trillion in purchasing power for people who hold cash. That $2.03 trillion doesn't disappear. It transfers to people who held assets that appreciated faster than inflation. The mechanism is a hidden tax that requires no legislation, no visible collection apparatus, and no political accountability. This isn't the first time a major economy attempted to solve structural problems through monetary expansion. The parallel is precise and terrifying. Weimar Germany in the early 1920s. Before you dismiss this as hyperbolic comparison, look at the actual mechanism and sequencing, not the ultimate outcome. Weimar Germany faced crushing war reparations, political instability, and economic devastation. The government responded by instructing the Reichsbank to expand the money supply to fund reconstruction and social programs. Between 1919 and 1923, the German money supply expanded by a factor of approximately 3 trillion. Obviously, the scale dwarfs anything happening in America currently. But the mechanism was identical. Create money, inject it through banks and government spending, generate asset price inflation first and consumer price inflation later, transfer wealth from savers to asset holders and debtors. German industrialists who held factories, equipment, and real assets saw their wealth preserved and even enhanced in real terms. Working-class Germans who held savings in Reichsmarks saw their wealth completely destroyed. By November 1923, a loaf of bread cost 200 billion marks. Life savings became worthless. The middle class, which held wealth primarily in bonds and bank deposits, was wiped out financially. This created the political conditions for extremism and eventual Nazi rise to power. The American situation isn't Weimar Germany in 1923. The dollar remains the global reserve currency, providing structural advantages that the Reichsmark never possessed. American productive capacity, while declining relative to China, remains substantial. The comparison isn't about ultimate collapse. It's about mechanism. Both situations feature governments using monetary expansion to avoid painful structural reforms. Both transfer wealth from the politically powerless to the politically connected. Both destroy the purchasing power of the middle class while enriching those already wealthy. The difference is velocity and scale. Weimar's monetary expansion happened over 4 years. America's current expansion is 14 months. Weimar expanded the money supply by a factor of 3 trillion. America is expanding by a factor of 268 going from 21. 4 trillion to 27, 13 trillion. The velocities are remarkably similar when you adjust for total economic size and time frame. This should be alarming to anyone who understands how these situations typically resolve. Here's the geopolitical dimension that connects this back to great power competition. Every dollar of American monetary expansion weakens dollar hegemony and strengthens China's position in the global financial system. Let me explain the mechanism with precision. The dollar's status as global reserve currency provides enormous advantages to the United States. Foreign central banks hold approximately $1 trillion in Treasury securities as reserve assets. This demand allows the United States to borrow at interest rates 5 percentage points lower than would otherwise be possible. The exorbitant privilege of reserve currency status saves the U.S. government approximately $200 to $350 billion annually in reduced interest payments on the national debt. But reserve currency status depends on confidence in long-term purchasing power stability. Foreign central banks hold dollars because they trust the dollar will maintain value over decades. When the Federal Reserve expands the money supply by 8% in 14 months, that confidence erodes measurably. Why would China or Saudi Arabia or Japan continue holding trillions in Treasury securities if the Federal Reserve will simply print away the purchasing power? The data shows this erosion clearly. According to Treasury Department data, foreign official holdings of U.S. Treasury securities declined from $1 trillion in March 2024 to $4 trillion in February 2025, a reduction of $700 billion in less than 1 year. China specifically reduced holdings from $1 trillion to $890 billion, a decline of $210 billion. This isn't random market fluctuation. This is systematic diversification away from dollar exposure in response to American monetary policy. Where is that money going? Increasingly into gold, other currencies, and Chinese yuan-denominated assets. China has been systematically building alternative payment infrastructure through the Cross-Border Interbank Payment System, CIPS, which processed 6 trillion yuan in transactions in 2024, up from 74. 2 trillion in 2023. This represents growing international acceptance of yuan for trade settlement and reserve holdings. The mechanism is self-reinforcing. American monetary expansion drives foreign central banks to diversify away from dollars. This diversification reduces demand for treasuries, forcing higher interest rates to attract buyers. Higher interest rates increase government debt service costs. Increased costs create pressure for more monetary expansion to keep rates manageable. More expansion drives further diversification. This is a doom loop that ends with loss of reserve currency status and dramatic reduction in American living standards as the import subsidy from reserve currency demand disappears. China doesn't need to attack the dollar system militarily or financially. They just need to provide viable alternatives and wait for American policy mistakes to drive the transition. The $73 trillion stimulus is exactly the kind of policy mistake that accelerates this process. Every time the Fed expands the money supply dramatically, Beijing celebrates because it represents another step toward a multipolar currency system where the dollar is one option among several rather than the obligatory global standard. Let's bring this back to immediate practical implications. If you understand the Cantillon effect and you recognize that 73 trillion in new money is entering the financial system through channels that benefit asset holders first. What should you do with your savings? The conventional financial advice is to maintain 3 to 6 months of expenses in an emergency fund and invest the rest in diversified portfolios of stocks and bonds. This advice made sense in an era of relatively stable monetary policy and moderate inflation. It's catastrophically bad advice in an era of massive monetary expansion and deliberate currency debasement. Here's the brutal reality. Holding dollars in savings accounts during this expansion cycle will result in 15 to 20% purchasing power loss over 18 months. This isn't a theoretical possibility. It's the mathematical consequence of 26. 8% money supply expansion flowing through an economy where you receive the new money last after prices have already adjusted. The alternative is to position yourself earlier in the Cantillon sequence by holding assets that appreciate before consumer prices rise. This means stocks, real estate, commodities, and potentially Bitcoin. Each of these asset classes has captured significant value during previous expansion cycles, and there's no reason to expect this time to be different. But here's the trap that most people fall into. They see asset prices rising and assume they've missed the opportunity. Stocks are at all-time highs, I'll wait for a correction. Real estate is too expensive, I'll rent and save. This waiting means you're holding dollars that are losing purchasing power by the day. The expensive assets keep getting more expensive in nominal terms because they're absorbing the monetary expansion while your dollars sit idle, losing value. The correct strategy, painful as it is to accept, is to convert as much cash as possible into hard assets immediately. Not after you've done more research. Not after the market corrects. Not after you feel comfortable. Immediately. Because every day you wait, the Cantillon effect transfers more of your purchasing power to people who positioned earlier. For a typical household with $50,000 in savings, this might mean keeping $10,000 for genuine emergencies and deploying $40,000 into a mixture of stock index funds, real estate investment trusts, and commodity exposure. Yes, this increases short-term volatility. Yes, there will be moments when these assets decline in value. But the alternative is watching your purchasing power decline by 15 to 20% with certainty rather than accepting market volatility with the potential for gains that outpace inflation. You might be wondering why, if this mechanism is so clearly destructive to the majority of Americans, the policy continues. The answer is straightforward. The people who benefit from monetary expansion control both political parties and all major institutions. The top 1% of American households by wealth own 32. 3% of all household wealth, according to Federal Reserve data. The top 10% own 69. 8%. These are the asset holders who benefit from the Cantillon effect. They are also the donor class that funds political campaigns, owns major media organizations, and staffs the revolving door between Wall Street, the Treasury Department, and the Federal Reserve. Between 2020 and 2024, the finance, insurance, and real estate sector contributed approximately $9 billion to federal campaigns and political action committees. Technology sector contributions totaled $1 billion. These are the industries and individuals whose wealth increases dramatically through asset price inflation. They have every incentive to support monetary expansion regardless of its impact on the working and middle classes. Contrast this with the bottom 50% of households who own 6% of total wealth. They have almost zero political influence, despite representing half the population.